for Bitcoin to be successful, not only has to be scarce, it's usage as a store of value, as what the things it aims to do, have to stay the same or go up over time. So generally, someone's bullish on Bitcoin, they think, one, it's a good network, it solves a problem, it's scarce, and then two, that I think that's going to continue taking market share, and that, say, 5 years from now, more people will be holding Bitcoin than they are today. And if that thesis holds, you probably should expect Bitcoin to do well, especially in the face of dollar debasement.
Financial analyst Lyn Alden recently shed light on troubling market trends, pointing to the alarming drop in gold prices driven by factors like the stronger dollar, climbing interest rates, overly optimistic inflation projections, and a deeply pessimistic market atmosphere. Alden warns that traditional assets may fail to protect against monetary turmoil, pushing for high-demand investments like Bitcoin as a last-ditch defense against currency devaluation. Alden explains that central banks' aggressive money-printing schemes to meet inflation targets risk spiraling out of control. While productivity gains could theoretically mitigate inflation, certain sectors, such as healthcare and education, face runaway price increases due to lack of automation. She cautions investors about the dangers of monetary dilution, as expanding money supply often surpasses the official CPI. Bitcoin's fixed 0% supply growth positions it as a lifeline amidst this chaos, but its future is far from guaranteed, hinging on its ability to maintain value and dominance in a volatile market. Relying on traditional assets like IBM stock might expose investors to losses as companies struggle to retain market share. The hope for Bitcoin rests on its scarcity, its ability to solve real economic problems, and its adoption rate. Should these conditions falter, the consequences could be severe, particularly in an environment rife with monetary erosion. Alden's analysis serves as a stark reminder of the critical importance of understanding inflation, productivity limitations, and the fragile nature of scarcity in investment decisions. For more in-depth analysis, watch highlights from Lyn Alden's enlightening discussion. Don't forget to like, subscribe, and enable notifications for updates on compelling content like this. Enjoy the video.
Central banks have positive inflation targets. They want to have prices go structurally up, despite the fact that technically prices should go down. And so they manage that by encouraging more money creation, either from bank lending or fiscal deficits that they can monetize. And so to your question of can we grow out of it? Partially you could, if you had something that dramatically reduced the cost of energy and made energy way more abundant. Anything that massively increases productivity, like AI, offshoring and automation were the big productivity enhancers for the past few decades. That's why, for example, most of the inflation shows up in things like hospital services and childcare services and education, things that haven't really been automated that well yet, that actually require a lot of expensive domestic labor. Whereas anything that you can offshore, anything you can automate, ranging from electronics to software to shirts, that's not been very inflationary. In many cases, outright deflationary. And so you have that big mix there. So inflation's a spectrum based on how good we are at improving it versus that structural background monetary debasement. And then that gets to the second point, which is I think when it comes to investing, you always want to ask the question, am I being diluted? And if so, how and by how much? And so, for example, the money supply grows faster than CPI, usually. And that's because, again, the baseline for inflation is negative. And so if you have something like 7% annual money supply growth, which is what we've had in the U.S. for about 60 years on average, in developed worlds, generally pretty similar to that number. Emerging world, like developing countries, usually higher than that. So 7% money supply growth. If you have 4% annual productivity growth, you're going to get something like 3% CPI. And it's tricky depending on how you can tweak your basket for how you're measuring CPI. You can tweak around productivity, but basically that's how that gets broken up. And so even if productivity growth is high, and you're keeping up with CPI, you could still get diluted. meaning that you're not investing as well as you could be, because you could be owning the scarcest, best things that are not diluting you or diluting you very little, versus things that are diluting you a lot, but still managing to kind of partially maintain purchasing power. If you look at something like Bitcoin, it has long-term, it'll have zero supply growth. So you, in the long arc of time, fully diluted, zero dilution. Even now, the supply inflation rate is below that of gold, and will, because of the halvings, will asymptotically approach zero. And so that's kind of how you can think of dilution rates. And then when you look at, for example, the other factor to consider dilution, to finish that point, is market share. It's not just, you have to have something that's not just scarce, but is dominant for the thing that it does. So, for example, if you own IBM stock, right? IBM has been buying back its own shares. It's a deflationary asset. It's even scarcer than Bitcoin, right? The supply is going down. But IBM has structurally been losing market share in the whole tech infrastructure stack. Yeah. And therefore, your share of a segment of tech infrastructure, for example, is being diluted, even though your units of IBM are not being diluted, but IBM itself is being like pushed away by these other entities, and you're owning a piece of a shrinking pie. And so for Bitcoin to be successful, it not only has to be scarce, it's usage as a store of value, as what the things it aims to do, have to stay the same or go up over time. So generally, someone's bullish on Bitcoin, they think, one, it's a good network, it solves a problem, it's scarce, and then two, that I think that's going to continue taking market share, and that, say, 5 years from now, more people will be holding Bitcoin than they are today. And if that thesis holds, you probably should expect Bitcoin to do well, especially in the face of dollar debasement.
Lyn Alden's insights on productivity growth and inflation provide crucial perspectives. She emphasizes that low productivity growth worsens deficit-driven inflation, while robust growth can offset it. Alden notes that inflation impacts various sectors differently, with assets linked to scarce resources, like Bitcoin, holding value amid rising prices. To combat inflation, she recommends investing in high-demand assets, such as leading tech companies, gold, Bitcoin, or premium real estate. This strategy maximizes their potential for appreciation, making them effective tools for wealth protection as Bitcoin's price continues to surge. Its scarcity and adoption make it a compelling hedge. Furthermore, tying a short position in fiat currency to real estate investments enables investors to leverage the differential between depreciating currency and appreciating assets effectively. Alden also cautioned against debt monetization, highlighting the need to own assets with significant market share and cash flows while shorting rising currency supplies. This approach efficiently protects wealth against inflation and monetary debasement. Let's go back to the interview and watch more clips to gain insights from Lyn Alden.
So I think that the productivity growth doesn't really impact the deficits too much. What it affects is how inflationary those deficits are. If you have high deficits, but you have pretty low productivity growth, or even negative productivity growth, then those deficits are more likely to show up in inflation. Like if we're not doing a good job of gathering new energy and increasing our automation and making our supply chains more efficient, then that money supply growth over time is more likely to transfer into goods and services going up in price. On the other hand, if you have pretty significant productivity growth, then at least certain areas won't increase in price as much as you think, because it's offsetting the size of the deficits. But then there's the case that inflation is a spectrum. And so, for example, over the past 100 years, waterfront property has been very scarce, followed by fine art and gold, which are pretty scarce. And then there's things like oil, which we have gotten better at finding, but it's still fairly an energy-intensive and scarce process. And then you go down to soft agricultural products, grains and soybeans. They'll be very good at making more of over time. Things like electronics. And so you have this like spectrum. And if you're holding things like dollars or treasuries over the long period of time, the things where the productivity growth is coming from are probably not getting more expensive than you. Like a dollar can literally buy you like more television than it could 20 years ago. Like for a couple $100, you can get a decent television that's better than the television you could have gotten 20 years ago, because the productivity growth of making televisions has exceeded even the debasement rate of the dollar. Same thing for a lot of electronics and some textiles and things like that. On the other hand, if you were holding gold, then not only did you keep up with that, you can buy multiple TVs for the same amount, the same ounce of gold you could before. And Bitcoin's not been around for 20 years, but basically over time, if Bitcoin is successful at growing in adoption and remaining scarce, then you could buy even more televisions. Basically, you still want to, no matter what productivity growth is relative to the fiscal deficit, the debasement that's happening, you still don't want to hold the denominator that's diluting you. And instead, you want to hold the things that are scarce and attractive and that are at the top in their game, right? So, you want to own the big tech monopoly stocks, whatever the trends, like whatever is dominant, you want, and not heavily diluting its shareholders. That's what you want to own, or gold, or Bitcoin, or certain high quality real estate that you can. One of the best things about publicly traded companies and real estate is you can also attach a fiat currency short to it. You can attach a 30-year mortgage. So if the money supply is growing by 7% a year, there are people that took out 3% mortgages. And you're on the right side of that. You're shorting the currency that's getting diluted, and you're buying a house which gets slowly diluted and has maintenance and taxes. But you're kind of arbitraging that spread. And the same thing if you buy like a blue chip stock. Like why? Procter & Gamble's been around for like a century. They've been profitable for decades straight. Why do they have debt? Like they have billions of dollars in debt. And the answer is because they're arbitraging that. They're using that fiat currency short. Because they can issue, until recently, they could issue like bonds at 2% yields for 5, 10, 20 years. And they're shorting fiat currency against their more valuable equity and the assets that they own and the cash flows that they can increase prices on over time. And so basically the combination of owning fairly scarce things that maintain market share in their space, and then either having, and then shorting things that are rapidly increasing in supply and therefore not retaining their value. So debt monetization occurs when the central bank and its broader commercial banking system are increasing the money supply to buy and hold a significant portion of government debt. And so if you have debt being issued and it's not being monetized, then you have what is effectively a crowding out effect.
In related developments, a recent article by the Bitcoin Policy Institute makes an argument for central banks to accept Bitcoin as a reserve asset. The author, economist Matthew Ferranti, believes that Bitcoin's unique properties make it a good hedge against inflation, geopolitical threats, and economic restrictions. Ferranti emphasizes Bitcoin's low correlation with traditional financial instruments, lack of counterparty risk, and store of value attributes comparable to gold. The report indicates that central banks could profit from devoting some of their reserves to Bitcoin, particularly to offset the risks associated with sovereign defaults and fast currency depreciation. However, Ferranti acknowledges that Bitcoin may not be appropriate for every central bank. The idea has received support from U.S. lawmakers and presidential contenders, with Senator Cynthia Lummis introducing the Bitcoin Strategic Reserve Bill. The law seeks to purchase 5% of Bitcoin's total supply over time. Former President Trump has also expressed an interest in using Bitcoin to address the national debt. Proponents, such as MicroStrategy CEO Michael Saylor, see the Strategic Reserve Plan as a bold move similar to the Louisiana Purchase. However, not everyone is as enthusiastic, with Cardano founder Charles Hoskinson warning that state actors could affect the Bitcoin network. The discussion about Bitcoin's possible position as a reserve asset emphasizes the importance of carefully considering the consequences of changing the status quo. As we conclude, how does Lyn Alden's investment strategy address Bitcoin's volatility, and what role does she anticipate Bitcoin playing in a diversified portfolio intended to resist inflation and economic uncertainty? Please drop your thoughts in the comments below, share this video, and hit your thumbs on the like button. Thanks for watching. Don't forget to subscribe.